Next, we speak with David Altig, Director of Research for the Federal Reserve Bank of Atlanta. We learn how the Federal Reserve establishes interest rates in an effort to help spur sustainable growth in an economy. David Altig, thanks for joining us on the Illinois Channel. We wanted to glean a little bit of what you're looking at as far as when you look at the economy and where we are now and where we might be going as a society, and then also maybe you can tell us a little bit about what the Fed does and how you put together your numbers. So as someone who works in research for the Fed, let's just a basic view. What is your job and how do you go about doing it?
Sure. So my boss is the president of the Federal Reserve Bank of Atlanta. Federal Reserve Bank of Atlanta is one of 12 reserve banks in the country, each with their own presidents, and they serve with the Board of Governors in Washington to set the course of monetary policy via the Federal Open Market Committee for the United States. So when you hear people talking about what's going to happen to interest rates, often they're talking about us.
For those who don't speak, as I say, economic geek, people, as you probably know, will use interchangeably fiscal policy and monetary policy. It's not the same. Tell us what monetary policy is.
Well, monetary policy really is about regulating the supply of money in the economy, but more kind of directly, we influence short-term interest rates, which then influence longer-term interest rates and the sorts of prices people pay for mortgages and auto loans and those sorts of things. It's not a direct control of those things, but it's an indirect control to influence the economy. Mainly, we're charged with on inflation and employment.
And the Fed would look at how the economy is performing, and you might decide that the economy is starting to slow down, in which case you might cut interest rates to put more money back into the system and to goose the system a little bit, if I can use that phrase. Conversely, you might, if you see inflation starting to creep up, raise interest rates just to kind of tap the brakes and slow it down so we don't get runaway inflation. Is that more or less the policy?
That's pretty much exactly what the strategy is.
Now, you take the temperature of the economy through a number of different metrics. What would be some of those metrics, and how do you gather the information?
Well, the most important ones are the ones that are directly related to our responsibilities or our congressionally mandated objectives. That would be inflation, which we measure by a measure of consumer prices, and employment growth. Both of those things are statistics that are collected by the official statistics agency of the United States. So we look at, in some sense, at the very same data that you will pick up and read in the newspaper on those items.
Now, just recently, the Department of Labor in federal government Department of Labor comes out with the jobs report on the first Friday of every month. The last one was abysmal. I think we only had 38,000 jobs, and of those, 10,000 were created by government, not the private sector. When you see something like that, do you go, wow, or do you kind of say, it might just be one blip on the screen and we need to kind of get several months at one time before we start reacting to that?
Well, I think I did say wow when I saw it because it was a much weaker number than what we were expecting. Part of that was a reflection of a strike associated with Verizon. But still, even if you add that effect back in, it was still a pretty weak number. Numbers probably closer to 70,000 than 38,000, but that was still quite low. On the other hand, we do try to put things in perspective. Those numbers can jump around month to month. So, it's not my view that the 38,000 was really reflective of the course that the economy's on and the pace of job growth that we really expect to see going forward. But it was a low enough number to give us some pause.
Now, I'll say you as an organization are not political, so let me ask you something, and I'll try to make it non-political.
Okay.
But as we are in the middle of a presidential race, we are going to hear the candidates say different things that they would do to get the creation of jobs, and both Hillary Clinton and Donald Trump are saying that. When we look back, and by the way, that would be fiscal policy. They're going to say they're going to raise taxes, lower taxes, or something along those lines. I hear different people saying things like Ronald Reagan caused a deficit, the massive deficit because he cut taxes. When we cut taxes, is that, you've probably, I would guess, researched the result of tax cuts over time. What is the net effect of that typically for an economy, if you can say, and for revenue to the federal government?
Well, so it's a fairly complicated question, actually. So on the one hand, when you cut taxes, you may change incentives that are positive for the decision makers or the people who are receiving the tax cuts. You put a little bit more money in their pockets, which is potentially a good thing. But on the other hand, you have to finance those tax cuts either by borrowing or reducing government spending. And so whether or not that's a good thing depends upon kind of whether or not the government spending you either have to cut today or cut eventually to pay off the deficits you're incurring, whether those are really productive sort of cutting into the muscle sort of cuts, or whether they are bridges to nowhere or something like that. And so there's no rote answer to that question. The devil is always in the details, and those details, of course, are the things that people who make fiscal policy have to focus on most intently.
I might point out that George Bush had two tax cuts. One was a child tax cut where everyone got $1,000 a year for whatever kids they had, and the second tax cuts he had in 2003 were in the marginal tax rates. Mm-hmm. When we look at tax cuts, which would typically be more helpful to an economy? Is it the kind of thing where we give people $1,000 for their having a child, or where we would cut the marginal tax rates, in other words, lower the rates on what people pay on their income?
Well, if you take to heart the idea that the incentive effects of tax rates is what you really should be caring about. That is, you don't want to disincent people to earn income or to consume or whatever the case may be. The marginal tax rates will have the largest impact in that regard. But of course, there are lots of considerations that have to do with sort of what you think the appropriate social policy ought to be, which are, that's for people to decide on determining who they want to vote for. The economics, really are about something different than value judgments.
I suppose the best tax policy is to make it simple, kind of like sticking that carrot out in front of the donkey to get them to incentivize it to keep working and doing more and producing more.
Uncertainty about anything is the killer of growth, and so to the extent that simplifying makes things more certain and easier to make decisions, be they personal decisions or business decisions, the better off we'll be.
Let me ask you just a couple of last questions. How fast is the American economy growing at this time, and do you have a projection for where it might be in 2017, 2018?
Yeah, so my forecast is my forecast, and that of my colleagues on the staff at the Atlanta Fed. We're thinking that the first half of the year will have grown roughly somewhere in the neighborhood of 1.8 to 2%. Probably say something slightly better than that in the second half of the year. So we would guess we get GDP growth this year of somewhere in the neighborhood of 2%. I think that's our current guess.
Do you have a projection for the next 2 years, or do you?
Well, the next 2 years I don't think would be too dissimilar from that. We're hoping for something maybe a little better, but right now something around 2 to 2.25% seems like the best guess.
Am I correct that we need growth of approximately 2.5% to absorb those coming into the workforce?
No, I actually think that it's likely that 2 to 2.25 will do the trick. Part of that is a reflection of the permanent pace of the economy is probably a little lower than 2%, maybe 1.75%. So that would be the potential growth of the economy over the next couple of years. And if we grow moderately above that, we'll make moderate progress on absorbing people into the labor force who are still waiting on the sidelines.
All right. David Altig, we appreciate you taking time to speak with us.
Thanks so much.
Thank you.